So I found an absolute banger of a stock. This company is severely undervalued. The sector is also undervalued. The financials look great. And by pretty much every metric, this company is an absolute steal at its current price. But there is a big catch. I'm not going to tell you what this company is. In fact, I'm going to leave it to you to make your own assumptions on A, what this company is, but B, is it a buy? And more so than that, I'm not even going to tell you if I currently own the stock itself. This is completely allowing you, the viewer, to make your own decision on whether you think this company is good value and worth a look into without knowing what the company is. Now, I know most people are going to be guessing what company this is, so let me know down in the comments what your guesses are, and if you get your comment deleted, then it simply means that you guessed correctly, and everybody else, unfortunately, you need to guess again. I know this video is a bit different, so also let me know if you like this kind of thing on a separate comment. Now, before we dive into the financials of this unknown company, make sure you smash the pants off the like button. It would severely help me out with the YouTube gods, and we've done some changes to the chat room, so if you want to check out Discord, not Echofin, check it out via the link in the description, and our WhatsApp group is still available via Patreon. But if you want to get access to our eToro chat room, check out the link on the pinned comment. Sign up to eToro, make a trade, and you do indeed get lifetime access to our eToro Discord room. Now, it's something a little bit different to the channel. I did a video recently that didn't do too well, but in the comments, you seem to like it. I did a blind stock analysis on picking 3 random stocks from the S&P 500 and forcing myself to buy one of them. In fact, I should really check how that's actually doing in an upcoming video. I haven't checked it for weeks. Hopefully, I haven't lost my arse on that one. But I think this will be a very valuable video. It'll teach you a process, and at the end of it, you can make your own decision whether you should buy or sell it. The only difference is I'm not putting a gun to your head and saying you need to buy this company because, well, I can't really do that. So right off the bat, it is a well-known name. It's a company that I'd say majority of people have heard of. It was at one point a well-known brand worldwide, and sort of has fell by the wayside, and that is reflective in their market cap. It's not a huge company, trading at current around about $1 billion US. Yeah, it's quite a small market cap, but I still think this company is severely undervalued. They have a trailing 12-month PE ratio of around about 3 to 4, which is definitely good. Remember, we want the PE as close to 1 as possible, and the way a PE works, the price to earnings ratio, is basically you're getting the price of the company and dividing it by their earnings, and that should give you how much you should be paying for the company. But their 5-year PE is a little bit higher. It's around about 12.96 as a 5-year average. And if we look down to their financial health, we can see they're well covered. They have 318 million in short-term assets with 138 million in liabilities, and long-term assets is 174 with 53 in liabilities. So very well covered, and seems to be a very well-run business. Seems too good to be true, as we know very little at the moment. But let's see how we get on. Their revenue is actually quite good. In the last 5 years, they've gone from 825 million US dollars in revenue to a staggering 1.1 billion in revenue. Now remember, last year they earned 1.1 billion in revenue, but they're only a billion market cap. That in itself should scream, I'm value, pick me, pick me, pick me. But their net income, unfortunately, is a little bit all over the place. In 2017, they made 90 million. In 2018, they made 29 million. In 2019, they made 8 million. And in 2020, they lost 10.7 million. But this year, wow, what a roller coaster. 280 million US dollars in net revenue. So this company clearly has had a bit of a dip and started to, I don't know why I did that, but started to look to the upside. But over the last couple of years, something has happened that's caused this dip, and that's something that we don't know what this company is, we should really be looking into. Now, one of the biggest things we look for is dilution. And why do we look for dilution? We look for companies that are selling shares at the market. And what this means, the same example as always, is if you have 10 shares on the market and you own one, you own 10% of the company. But if the company then adds another 10 shares to the market, so now there's 20, you still own one, and it means you now own 5% of the company because the company has diluted you and you now own less of the total company. Dilution is not good. We want the inverse. We want companies to be buying back shares, meaning that if we have this example, we have 10 shares, I own one, they take off 2, Now, I don't know what the math is on that, but now I own a lot more market share of the company. Sorry, it's been a bit of a heavy day, and I haven't even opened a whiskey yet. But they have been buying back shares over the last 5 years. They've gone from 53 million down to 48 million, which is a big tick in the box for me, especially given the fact that their net revenues have looked like this. I don't know, again, doing this, but they have bought back shares nonetheless in this period. So it's a good thing to see. If we look at one of the other important things, their free cash flow, we can see that in 5 years, they've gone from 24 million in free cash flow to a staggering 318 million in free cash flow. A shocking figure. And what a rise that is. That's like some serious Apple and Facebook shit right there. But if we look at the free cash flow in more depth, we can see that from 2017, they have gone from 24 to then to 85 to then to minus 13, then all the way up to 189 and then to 318. So it looks like the company has sort of, again with their net revenues, gone down and now it's skyrocketing to the upside. So you could be buying sort of a emerging company here that could one day dominate its sector. And I'm not giving away that sector just yet. But again, this says that we need to sort of have a look why it had this dip in the last couple of years. It could be down to the Miley Cyrus, but this actually started before then, so we need to do some more research on this company. The dividend is coming in at 1.2% as well, which is well covered because it comes in at around about 12 million US dollars in payments, but they have an average 5-year free cash flow of 120 million. So 10% of that free cash flow average goes to dividends, which means they've got another 90% to invest in new businesses, grow the company, or, my favorite, buy back shares. So I was reluctant to put this out there, but I know some of you are probably scratching your head saying, what the hell is this company? It used to be trading in July around about 35 US dollars, and since then it's fell about 40% and is currently riding around $20 at the recording of this video. Hopefully that does not give it away. Again, it's quite a well-known company. So now we know the basic fundamentals of the company, and it does sort of scream out it's good value. But on this alone, I want to ask you a serious question. Would you buy a company with these financials if you knew the name? You don't know the name currently, and again, I'm not going to give it away in this video. That's up to you to guess. But you don't know the company. And this is what I'm trying to instate into people who've watched this far in the video. Most of the audience probably didn't make it this far, so I'm going to reward you. This is what you need to install into your investing. You need to see past the name. For example, if this company was clubbing baby seals, but their financials were still good, or if you look at a company like British American Tobacco, and it's not British American Tobacco, it's a company that is selling cancer, but their financials are good. So if you can get over that, would you still invest in it? That's what I'm trying to instill here. Just because it's a name or that you don't like the company's business model does not mean it's not good value. These simple fundamental points are something every investor should be looking at before they pick a stock. So I hope that does instill a little bit of sort of process into just 1 or 2 people watching this video. So what do you think? Would you buy this company right off the bat? If you had $100 and you had to say yes or no, and this is the last chance you could ever invest in this company at this price, would you say buy or would you say no? Let me know that down in the comments. I know that's like 3 comments I've asked from you so far, but there'll be a 4th one coming in a minute. But let me know that down in the comments, because I'd love to hear if you want to know more. You'd need to know more before you invest. You wouldn't gamble with it. Just a bit of an interesting experiment for me. If a company's numbers look good and it looks like it's good value, regardless of the name, surely it's worth an investment. That's what I'm trying to instill here. Maybe though you do more research, as I definitely would with this criteria. But that said, $1 in revenue is $1 in revenue, and value is value. If you want a clue on what this company is, make sure you have tickle that like button until it turns blue, because this company was founded in 1856, which has absolutely nothing to do with the like button. And if you want to learn about some more value stocks, check out that video up there. Make sure you have commented the code word, which is sandwich, which has absolutely nothing to do with this company, and I'll see you in the next one. Take care. Peace.